Tonight we're talking investment wisdom, and what better guest than the award winner from the Raging Bull Awards 2012, won 2 awards in fact, and a man who's seen it all. Supposedly, David Shapiro joins us as we endeavour to learn from his lifelong lessons of markets and investing. Welcome to the show, and David, it's good to have you on the Wealth Quest desk.
Take us back. Took me a long time, that, you know.
I know.
40 years to finally win a Raging Bull. You know, I'm a pretty slow learner.
Well, there we go. Congratulations, and 2 Raging Bull Awards, David. 1972, you joined the stock market. Why?
Have you seen those rands at the back of the screen there? I recognize them. I don't think there's anybody else here who actually saw a rand at that. Why did I join the stock market in 1972? I actually qualified as a chartered accountant, and the last place on earth that I wanted to do is continue in accountancy. You know, most of my articles, I think the highlight of my articles is that I played soccer for Wits. And you know, I was more focused on playing soccer for Wits than actually learning about accountancy. But I did get through. I did qualify, and I joined the stock market as a runner in the old floor. I was actually a runner. I used to run messages, and I loved the floor. I learned so much there. I learned so much about business and so much about people. So it was a wonderful experience. That it's a bit sad that people don't have a chance of actually surviving or functioning within a trading room.
I mean, David, the interesting thing is maybe to understand your history better, we need to maybe to go back a little bit further than when you joined the market in 1972 and maybe go look at your dad, because your dad was a stockbroker,
yeah.
Archie Shapiro.
Yeah.
Now, in your answer, tell us, did your dad famously wear a badge that said buy gold?
In fact, if you would have sent me an email, I would have brought it here. He actually did. He used to, you know, the difference is that he was brought up at a very different time. And it was at a time when we had 40 odd gold shares quoted here. And there was also, gold shares were sought out. Let me put it another way. We were the resource capital of the world. If you wanted to deal in resources, you came to what they call the Cape. You know, that was a nickname for South Africa. The other thing is that when I first came to the market, there was no direct dialing. You couldn't pick up a phone and phone anywhere outside of the world. So we still dealt by telex machines. In fact, we still had a telegram system by which we communicated. So with the difference in timing, there was something called arbitrage. There were a lot of brokers who were arbitragers who would buy shares either in foreign markets and sell them here for a profit, or vice versa. And that's where my dad became, that's where they built their reputation in becoming arbitragers, dealing offshore. And but he dealt, in De Beers was his big share, and also in gold shares. But the market was thriving at that stage. It was a huge market, and as you walked into the market hall, gold shares and mining shares dominated the hall. On the left were financials, on the right industrials, you know. And if you were a good dealer, you were a gold dealer or in financials. So that's where the top people had. Today, it's completely different.
Sounds like the good old days. The move from floor trading, I worked in the JSE in Diagonal Street as well, and the move from floor trading to screen-based trading was quite a shift. And I think, as you said, you like to deal with people, and it was quite an emotional kind of interaction with different people. But how did that sort of change things? Because I know that some people just couldn't cope with sitting in front of a computer and trying to transact if they couldn't see the eyeballs of the other guy.
Dead right. First, you could understand the pitch of the market because you would hear the noise levels go. Also, when you went into the pit or when you went onto the floor, you could read your opposition. You could sense what they were doing. It became different once you were on a screen, but you adapt to that now. You know, once being able to adapt. First, the other thing is, and let's be honest, the efficiencies of the market have increased to the power of 10. So we're doing 10 or even 100 times more volume and value than we're doing at that stage. It was a very, very inefficient, and it wasn't a fair system because orders would come down and these poor dealers had to shuffle them into their pad. So you never got a fair deal. And of course, if you got an institutional dealer, all private clients were just brushed aside no matter when you put it there. So, you know, let's be honest, I think we've got a much more transparent system at the moment.
Is today's system necessarily more not transparent, yes, but more efficient? efficient because we've got so much news flow coming through. Everyone's so reactive. You know, positive headline, markets react, negative headlines. So in a sense, the market a lot more volatile. And of course, we get you on the desk here and you have to try and make sense of it. And sometimes there isn't any sense to it. It's just up and down on a daily basis.
The volatility is immense. I always have a lovely story because when we were on the market, you know, who went to the stock market? Who sold financial products? It was always the dumb chaps in the class, you know, the bottom end of the class. You know, we became accountants, etc. All the bright people, what happened to them? They became professors, lawyers, doctors, scientists. You know, who went to the stock exchange? Just chaps who couldn't find, you know, who couldn't fulfill that. And then suddenly we got computerized systems, you know, and all of a sudden all the clever boys, you know, the actuaries, those with a mathematical background said, hold on a sec, we can make money out of here. You know, we could put algorithms and trading systems, etc. And that's where all the problems arose. So I'm hoping that we actually go back to a stage where we get rid of all those very clever people and go back where the schmucks are back on the floor.
Is it not, I mean, David, is it not
Too late for that, surely, David.
David, is it not fair to maybe say that, I mean, stockbroking, if you go back to the good old days of stockbroking, it really was an old boys club. I mean, it really wasn't, you know, I mean, you needed to know people to actually get yourself onto the floor. If you didn't know people or you weren't part of the right family, quite frankly, you weren't going anywhere.
You're absolutely right. It was like an old boys. You needed someone to get you the job. And also, it was very cliquey on the floor. And if the dealers didn't like you, they would exclude you. You know, so you had to be. You learned a lot of lessons there.
One advantage, of course, of being electronic trading, no one knows necessarily who they're trading with.
Yeah, but it was fun.
Yeah.
You were never lonely. You know, you were never lonely on the flight. And then the evenings, I mean, there were lunches that extended. You know, there was nothing better than a dealer's lunch, you know, because you'd hand your pad over to someone who would go watch them there. And these lunches would extend, you know, they were legendary, 1 till 3, 4 o'clock, especially on a Friday.
Now, David, with such an extended period of time in the markets and having seen so many things happening through time, what is your first memory of the market? I mean, you start working in the markets and you're busy applying your mind, you're trying to do the job at hand. The most memorable experience, the very first one that shapes you as an investor, what is that?
Not as an investor, I'll tell you what I remember, is that my dad had a voice. He had a huge voice from shouting over. So he was on the market for over 60 years. He had this voice that used to boom. And the one thing is that he never swore at home. He never used foul language. Never heard anything. But my first experience on the floor was that we used to phone through orders. You know, they used to come from a dealing room from London, you know, and these orders would come through and then you'd write them on a piece of paper and go down to the floor. And I'll never forget, and it's indelibly etched in my mind, an order came through from a firm, Williams de Bro. Strangely enough, Williams de Bro is now owned by Investec. And it came through and it said, bid you 40 cents for 1,000 Lorraine. Lorraine was a gold share. Bid you means we want to buy from you 1,000 Lorraine at 40 cents. And I added a naught. And that naught became 10,000. So my dad went and he bought 10,000 Lorraines at 40 cents from Manny Fisher. I don't know if you know Jonathan Fisher. Does he appear on the shows? It was Jonathan's father, Manny Fisher. And anyway, I went to him and I said, Dad, I made a mistake. It should have been 1,000. Well, I never heard my dad swear, but I heard language there. But the beauty thing is that the whole floor gathered around to see me being absolutely wiped out by my father. And I said to him, I can't believe it was the language. So what did I learn from that? Yeah. Never to add extra noughts to orders. You learned efficiency and to listen properly,
I want to bring kind of your views and your understanding of the markets and how they work back to kind of the Wild West days to today's Wild West on the markets, where there seems to be so much chatter around whether the levels right now are justified. So how do you work through all the noise around the markets right now based on your experience over many, many years?
The one thing is trust the market. Don't ever tell the market it's wrong. You know, and that's why you have to learn to measure the money flows as well as the fundamentals. Try and measure them up. And too many of our analysts only focus on the fundamentals, etc. So you've got to understand what's happening in Wall Street now. We're going into new high territory. We are in new high territory and that. Don't tell Wall Street that it's too high. There are times when it gets silly, as we've seen when booms crash in 87, etc. But
We're not in that time now.
Not at that time. So be careful. There will be times when when the markets do move too high. But I've never ever heard in all the time that I have been on the market, I've never heard somebody come to me and say, the market's cheap. It's always been high. If it's fallen, it's still too high, it's going to go lower. If it's higher. And so we have, from that, we have a saying that says, buy when it's high, sell when it's higher. So I think those are the lessons. You learn a lot, about markets. And if you believe that a share should fall and that the fundamentals are wrong and the market's pushing up, go check your fundamentals. Go and check the numbers again. I'm not saying it always works. Things sometimes can go wrong, particularly in illiquid shares. But with liquidity, be careful.
Do you think that's changed, though, since you've started investing? I mean, since the 70s, has those fundamentals changed? Or do you think that's just good, solid advice that's always been applicable to, let's face it, any asset that you had to buy?
Yeah, I think could be just measure it against liquidity, because sometimes illiquid stocks can throw you out. But don't ignore what the market tells you.
Yeah.
I'm not saying don't ignore fundamentals. Measure them up against.
Yeah,
it.
and I mean, we talk about that a lot on the show, which is we talk about holding periods, and we often say, and we talk about when you want to engage in equities, make sure that you have a long-term time horizon rather than a very short-term time horizon. And I mean, I would assume that you would agree with that. I mean, let's assume a client comes to you today and says, look, I want to put my money into equities. How long do you think I should have it invested? I mean, what is your classic answer to
Well,
something
you have
like
to
this?
give it time. You start a business, you can't start making a profit the next day. And really, investment is a business. So you've got to have a time horizon. But don't box yourself in. Don't call yourself, I'm a value investor, I'm a growth investor, who cares? It doesn't matter. Why do you have to label yourself? Just read the prevailing conditions. Sometimes it's good to be a value investor. Sometimes it's better to be a momentum investor. And at the moment, I'm very much a momentum investor. I'm watching the cash flows. I'm watching the momentum, and you can see it in our retailers. Watch the retail market. Who's buying the retailers? Why are the share prices not falling? I know we've gone through quite a big correction, but why are they not falling even further? Why is that not happening? And where's the money coming in that's actually buying them at these levels?
On that point, I mean, we're sort of hinting here at the role that foreign investors are playing in our market. Now, you mentioned earlier on that the orders that you got on the trading floor came through from London. Nowadays, we still get orders coming through from London or from emerging market investors, etc. But do you think that domestically the market is more or less driven by global effects than it was in those days?
We're much more today.
Much more today.
Because we never had internet. We never had the
No, but I'm talking about portfolio flows. So your sort of foreign investors coming in and moving the market away from fair value.
They're much, much stronger. You look at most of our retailers, they're 65, 70% owned by foreigners. So we are price takers.
25% PEs?
Yeah, doesn't matter. You can argue with it. That's what they're going to pay. So you can stand up and make a grandstand and say, it's much too high for me. But if the foreigners are buying it and they're prepared to buy it at those kind of levels and they have the money, believe it's going to hold.
Just before we take a break, one stock that you've had a lifelong love affair with, and perhaps it will continue till death do you part, and one stock that you've made a mistake on. And I'm sure there may be a few of those, perhaps.
The one, it's very difficult. I think there are a couple of stocks. The one thing that is misunderstood in the markets is luxury goods. And it's a different market. In fact, I heard an interview with the new CEO of Rolls-Royce, and he said, basically saying, the people who buy Rolls-Royce, doesn't matter, how much they earn. They are of that class. They are so wealthy. And that's why luxury goods has a life of its own. People buy luxury goods, whether it's a depression, whether it's a boom, whatever. And I think it's an area, but you've got to buy the ultimate luxury. So I love Richemont in the South African context, but I still think we're going to continue to drink beer, and I still think people will smoke. So those are my top three stocks, Richemont, breweries, and British American tobacco.
Well, on that note, let's take a break.
Old trading floor to me.
Nothing's changed, David. Nothing's changed.